Welcome to our year-end tax hack video. Today we'll show you how to use your year-end bonus to reach your 401k contribution limit and potentially reduce your current year's taxable income. We'll explain timing, payroll constraints, company match pitfalls, and a step-by-step plan to execute before December 31st. Here is today's agenda. First, we'll cover why this strategy works. Next, we'll clarify that the core constraint is administrative rather than legal. Then, we'll walk through a concrete action plan and timeline. After that, we'll highlight common pitfalls related to employer matching. We will also work through quick math examples and discuss advanced options for high savers. Finally, we will close with key takeaways and short quizzes. Let's set the context. The idea is to use your year-end bonus to increase your pre-tax 401k contributions and reduce your taxable income for the current year. For many high earners, this is one of the fastest and most efficient ways to defer taxes while boosting retirement savings. This presentation is for educational purposes only and does not constitute tax, legal, or financial advice. Contribution limits change by year, and individual circumstances vary. Always verify the current year IRS limits. Review your plan documents for details about matching and true-up policies, and consult your HR or payroll department and a qualified advisor before taking action. Here is why this works. First, pre-tax 401k contributions reduce your taxable income in the current year. Second, high earners with year-end bonuses can use the timing to fill any remaining contribution capacity quickly. Third, the main hurdle is not a legal one but an administrative one. Whether your payroll system can accept a very high contribution percentage on a single bonus check. Finally, always verify the current year IRS annual contribution limit and any catch-up provision if you are age 50 or older. Here is the action plan. First, email HR or payroll today to confirm whether you can set your bonus deferral as high as 100%. Second, ask if a manual override is required to apply a lump sum deferral on the bonus. Third, verify the cutoff dates for changing deferral rates before the bonus runs in payroll. Fourth, confirm whether your plan offers a year-end match true-up. Fifth, ensure that enough net pay remains to cover required tax withholdings and other deductions, because most systems cannot allocate 100% if mandatory withholdings are not satisfied. Finally, document your target by calculating your remaining limit, your year-to-date contributions, and the percentage needed on the bonus to hit the cap. This sequence diagram shows the workflow. The employee initiates a request to increase the bonus deferral. HR reviews the plan rules and confirms whether a true-up exists. Payroll checks the system limits and confirms the cutoff for changes. Payroll then applies any required manual override for the bonus run. The record keeper receives the contribution and tracks the year-to-date amount relative to the IRS limit. If the contribution would exceed the limit, payroll caps it and returns any excess to net pay. Finally, the employee confirms that contributions post before December 31st. Let's discuss timing and mechanics. Contributions need to be withheld from your paycheck and posted within the calendar year. Many payroll systems limit deferrals to a percentage of each check, which can make last-minute lump sums difficult without an override. Realistically, a 100% deferral may be blocked to allow room for required tax withholdings and deductions. Plan your sequencing by adjusting deferral rates before the bonus hits, and confirm processing windows with payroll. As a backup, consider splitting contributions between a regular late-year paycheck and the bonus. Here is some quick math using markdown notation. The formula for remaining capacity is remaining equals the current year limit plus any catch-up if age 50 or older, minus your year-to-date contributions. For example, if the limit is $23,000 and you have contributed $12,000, your remaining capacity is $11,000. If your bonus is $15,000, the needed deferral rate on the bonus is $11,000 divided by $15,000. Or 73.3%, so set approximately 74% to cover it. If you are age 50 or older, add the catch-up amount to the limit, and then recalculate the required percentage. This timeline shows the recommended cadence from mid-November to December 31st. In mid-November, email HR and payroll. In late November, confirm system limits and whether the plan has a true-up. In early December, submit your deferral change. In mid-December, verify the exact payroll run date for the bonus. In late December, Confirm the posting date with the record keeper. On December 31st, perform a final check that your year-to-date contributions equal the intended limit. Let's compare pre-tax and Roth 401k deferrals. Pre-tax contributions reduce your taxable income for the current year and are often attractive if you expect to be in a lower tax bracket in retirement. They also maximize immediate tax benefits. Roth contributions, by contrast, do not reduce current year taxes but can provide tax-free growth if qualified. Roth may be attractive if you expect a higher tax bracket later or if you want tax diversification. This table illustrates example scenarios. It shows the remaining limit, the bonus amount, the required deferral percentage on the bonus, whether a payroll override is needed, whether a true-up is available, and the level of match risk. Larger deferral percentages generally require a payroll override. The presence of a true-up usually reduces match risk. Without a true-up, front-loading may cause you to miss matching contributions in later pay periods. Also remember that systems may not allow 100% due to required withholdings. Be careful with the company match. Many plans stop providing matching contributions once you reach the annual dollar limit. If there is no year-end true-up, front-loading can cause you to miss matching contributions on later paychecks, which is essentially leaving money on the table. To protect the match, pace contributions across pay periods, or confirm that your plan has a true-up. If you are maxing late in the year, coordinate your deferral rate so that you still receive matching contributions on remaining paychecks. Quiz time. The question is, what is the primary barrier to making a large, last-minute 401k contribution from your bonus? The options are: A. IRS law forbids lump sum contributions. B. Payroll and benefits administration settings. C. 401k record keepers never accept late December postings. D. Brokerage trading hours. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Payroll and benefits administration settings. The main issue is administrative, not a legal prohibition. Second quiz question. If your plan does not offer a year-end true-up and you hit the annual limit by June, what is the likely consequence? Options. A. You will receive extra match later automatically. B. You may miss out on the employer match on later paychecks. C. Your contributions become Roth automatically. D. The IRS will refund the excess match. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Without a true-up provision, front-loading contributions can cause you to miss employer matching contributions on later paychecks. For advanced savers who have already maximized pre-tax or Roth contributions, consider whether your plan permits after-tax contributions and in-plan Roth conversions or rollouts to a Roth IRA, sometimes referred to as a mega backdoor strategy. Be mindful of plan rules, non-discrimination testing, and total contribution caps for the year. Here is your year-end checklist. Verify the IRS contribution limits and any catch-up amounts if you are age 50 or older. Review your plan documents and match policy, and confirm whether there is a true-up. Email HR and Payroll to request a high bonus deferral and ask about any manual override. Confirm the change cutoff and the exact payroll date for the bonus. Set your deferral rate to target the remaining limit while leaving room for withholdings. After payroll processes, confirm the posting with the record keeper and check your year-to-date totals. Finally, adjust your January deferral rate to resume normal pacing that captures the full employer match throughout the new year. This mind map lays out the major decision areas. The root is using your bonus to fund your 401k. The payroll feasibility branch includes system limits, the need for a manual override, and cutoff timing. The tax goal branch addresses whether to prioritize pre-tax now or Roth later, based on tax bracket expectations. The match strategy branch covers true-up availability and per-paycheck pacing to protect matching dollars. The mechanics branch includes required withholdings, posting dates, and year-to-date verification. Finally, the advanced branch addresses after-tax contributions and possible in-plan Roth conversions or rollouts. Here are the key takeaways. A large bonus combined with a high deferral rate is a fast way to max your 401k. The main roadblock is payroll administration rather than tax law. Confirm whether your plan offers a true-up to avoid losing matching contributions when front-loading. Act early by changing your deferral before the bonus payroll run, and verify that contributions post by December 31st. Finally, calculate the exact percentage you need on the bonus to reach the limit. To wrap up, plan early and coordinate with HR and payroll while confirming system limits. Target pre-tax deferrals on the bonus if your goal is to lower current year taxes. Protect the employer match by understanding whether your plan offers a true-up. Verify that contributions post before year-end and adjust your January settings accordingly. Thanks for watching. If this video helped you, please like, share, and subscribe for more practical money moves. Tell us in the comments how you plan to set your bonus deferral percentage and whether your plan offers a true-up.